Okay, as promised, we are about to have a little conversation about the winners and losers after we've had a slew of the big bank results. And of course, we're going to bring in event trader Gavin McGuire to do a little recap here. Welcome back, Gav.
Hey, what's up, Jim? How are you doing?
I'm doing well. Just want to give everyone a heads up that on the visual, I did post Gavin's most recent chart that really breaks down in a comparison form, a table form, of the major banks, their earnings, and some of the key metrics that they reported after this past earnings season. So I guess the best way to really get started on this, Gav, is to look at and say, hey, who's the winners and losers here?
Well, I think if you're looking for the winners, the one that's jumping off the page to me was Morgan Stanley's results today. They beat pretty much on every metric that was laid out in front of them, and just continues to really show a lot of growth from their move into the global wealth management business there. They decided to do this a couple of years back. This was shortly after the crisis when their CEO, James Gorman, made the push into that area, and it's been paying dividends. They've been posted some really good results for the last couple of quarters, and this one was no different. And even if you're just looking at their IB side, it seems like that they're paying dividends from their global wealth management, finding a little bit more quality of performance in their investment banking from the different money that they're managing. So that was probably the biggest winner. I mean, they had the strongest revenue growth, as we could see. They had the strongest net income growth, and also the strongest trading revenue growth. So really hitting on all cylinders. We saw a nice pop in the stock, but when you're just looking at the chart here, Morgan Stanley, if you're looking at the daily, you can just see it's basically got some heavy lifting to get through this 50 to 52 area, but really the results were certainly strong enough that we could see it break back above and move back towards those 57, towards that 56 to 57 area, which would lead to, back towards its 52-week highs and potentially break that downward trend that we've seen in place since early March.
Okay, out of these banks, what was the most surprising thing that you learned? What's the biggest takeaway that you had from this?
The biggest takeaway, there wasn't really anything that changed the narrative. I did think some of the concerns around the flattening yield curve might have been overblown. It's a little bit difficult to judge that because of the boost that a lot of these banks are getting from the tax reform, and that's really helping impact the bottom line. The biggest takeaway, and that's probably the biggest takeaway I would say, is just the fact that we're not seeing as much of a negative impact from the flattening curve as some would have feared, and I think that's kind of what's leading to this bounce in the XLF. It's a better than feared set of results, I think would be the fairest way to put it.
Okay. Let's set aside the actual stock performance. Has there been any of these names that you thought might have been, not reflective in what happened? So let's say one of these had better than expected earnings or better than expected result or commentary, what have you, and it didn't reflect in the stock's reaction, so that maybe there might be a delayed reaction, something maybe fundamentally underneath the surface that might be something to look out for as we progress through this quarter.
Well, I'd certainly say Goldman's sell-off in reaction to their earnings. Now, they did fall flat on their trading revenues, and we're going to go through kind of a report card for the full earnings, and I did have Goldman Sachs towards the lower end because of that trading miss. But I mean, they weren't far behind Morgan Stanley in rev growth and net income growth at 19% on the rev side and 40% on the net income side. Their FIC trading was by far the best in terms of year-over-year numbers, as that came in up 45%, as they really saw a lot of activity in there and performed extremely well well. And FIC, of course, is the fixed income, currencies, and commodities units. And then their valuation is the cheapest in the peer. Now, we are starting to see that action. We've been calling for it to get up to 237. I believe Scott Blue X, of course, is long this. And I don't know if Tech T has a long in this, but he likes the name. And we've been pretty positive on the commentary. Now, the report did leave a little to be desired, particularly on that revenue miss, but it was also going up, and that's on the trading side, but it was also going up against really tough comps from the prior quarter where it just blew out across the board. And there was also some uncertainty around the CEO succession headlines, and the fact that Lloyd Blankfein or David Solomon weren't on the call, I think, kind of weighed on sentiment a little bit. But we've seen that one turn around, and as I've been saying, I think that's your best day trading vehicle. I think that gets back up to the 237 area, and if it could get through that, then I think a test of that 246 200-day moving average will be in the cards eventually.
All right, let's take a look at the XLF and the performance since this has happened. So we've had a nice move off the lows. What's going to be the key driver moving forward throughout this quarter that can accelerate this to give us some potential upside?
I would say arguably, I don't want to say is a concern because it generally came in line, but I think more people would like to see a pickup in that loan growth. Now, one of the common themes that we've been hearing on conference calls is that trading headlines are having a impact on sentiment, but not necessarily on actions, on corporate actions. But I think we'd like to see a little bit stronger top line and loan growth there. Certainly a continuation of an improvement on the bottom line and a steepening of the yield curve would really help launch the group here. But this XLF, it's moving through some pretty difficult resistance levels here. Saw it get through the 20, bounced above the 50-day yesterday, and that's the first meaningful time it's been above the 50-day since early March. And now we're seeing it get above that convergence of the 100-day and 200-day, which is that 2770 to 2775 area. And this is also helping break that downline trend since it hit that multi-year high back on January 29, when it hit the high that day was 30.32. We've basically seen financials in a downward trend, and a lot of that's been reflective with that flattening yield curve. So to break above that trend line on the technical side would certainly be a bonus, and I think that's first and foremost to get this group going, since we're not really going to get that headline shock, either good or bad, from earnings results. But I think people would like to see a little bit more of an improvement on that loan growth lines and the revenue growth lines. As we could see, Bank of America was down 1% year over year, Wells Fargo down 3% year over year, Citi and JP Morgan were up 2% and 6% respectively. And then, of course, we got the IB-focused banks, Goldman and Morgan Stanley, which because the prior year Q2 trading environment was so weak, the Fed was still very active within the markets, which was just killing the fixed income segments for a lot of these IB units. We're seeing most of the revenue growth going there, but more on the consumer banking side, I think people would like to see, and again, that's reflected in the rev growth and the loan growth, which is you just put on. We could see decent, but nothing that's really jumping off of the page.
All right, so let's do this as a report card style, and we'll walk through some of these and give us your actual grades on these reports. We'll work from the left and work our way to the right, and we'll start with Morgan Stanley. What's your grade?
A-, easily the best report that I saw from the group this quarter. Now, it's funny because these report cards might not match up with where they stand trading-wise, but if you're looking at a longer-term investment, Morgan Stanley, like I said, has got those headwinds against that technical resistance, but they just continue to really perform well quarter after quarter. This has been going on for 2-3 years, and they've really closed the gap on Goldman in terms of the best IB bank out there. And I think that this is a pretty good longer-term investment vehicle. Whether or not it's going to be a great trading vehicle remains to be seen, just because of that technical resistance.
All right. What's your grade on JP Morgan, JPM?
JP Morgan, I have here as a B. They pretty much beat on the majority of their metrics. Their net interest margin did dip 2 basis points there. Their FIC was only up 7%, which wasn't the greatest. Trading revenue was up 12%, which came in third, was double digits. But JP Morgan probably has a little bit tougher of a grading curve too. So I had that in as a B, as basically just being an average report for JP Morgan. Now we take a look at that chart there, and seeing a nice break back above the 200-day, just is getting above the 100-day moving average today. So looking back, 114 is going to be the next line that we want to take a look at in terms of resistance. But I have JP Morgan in it as a B on this report card.
All right. How about Bank of America, BAC?
Bank of America, another B. Their ROE was 10.7 compared to 10.8% the prior quarter, and their return on tangible common equity was 15.1% compared to 15.3%. So that was probably the best quarter-over-quarter performance on those returns. So that's certainly a positive there. But, the negative rev growth raises a little bit of a flag there. The net income growth at 33% was certainly strong. Trading revs only came in at plus 6%. With their fixed income kind of being a drag there, as that was only up 2%. And their net interest margin fell 38 basis points to 2.01% from 2.39% in Q1. So, that NIM and the revenue growth was the reason why this was only getting a B. The valuation still remains very attractive there. And I still like the name. I'm still long the name. It's nice to see this get back over that 30 level, which I think is very important. And to hold above the 200-day will be very important for Bank of America. But overall, some of those drops that we saw, particularly in NIM and revenue, was a little bit of a headwind, and thus only getting a B in Bank of America. This remains the one that should be most impacted by any rate increases, but also on the flip side too, it's impacted by that flattening curve. So Bank of America stands to be the name to gain the most from a steepening yield curve out of this group.
All right, and now we'll look at Wells Fargo, ticker WFC.
Yeah, I gave them a C. This was the lowest one, and not really all that surprising, given some of the concerns around the constraints that have been put on them by the government because of their past sales practices that they've been hit on. That obviously kept the cap on what they could do in terms of mortgage originations, and thus led to a revenue growth decline of minus 3%. They were the sole bank that had loan growth of minus 1%, loan growth in the negative, and that certainly weighed in on the share price. Now, they probably saw the best reaction to earnings because there was a lot of view that this was a kitchen sink out of the way. However, they still are bumping into that 200-day moving average. You'd like to see it get above that, and if we do, I think a move back to the 60 area, which is basically the high since a lot of those negative headlines came out about some of their sales practices. But the move since earnings is encouraging. On the chart, we're seeing a little bit of a break from that downward trend since it hit its 52-week highs back on January 29th. You'll see January 29th is a pretty key theme for highs in a lot of these banks. That's, of course, was right around when we got the Mnuchin comment about the softer dollar, and then some of those trade wars really start impacting the overall market. And so we saw that grand sell-off in late January or early February, of course, and the financials were at the center of that maelstrom. So, Wells Fargo, it's looking decent on the chart. Obviously, again, you want to see it get above 200, but its earnings report for this quarter round as a C is, probably about as good as one could have hoped for, but certainly the laggard in the group here.
Okay, yeah, the chart looks pretty impressive with that ascending triangle that it seems to be developing right around where the 200-day comes into play. So looks like that just above the 57 area would be a good trigger point, I would think, and maybe just looking at this one, it gets a run up to close that gap if it gains some steam.
Yeah, and that's exactly what we're looking for. The XLF could be that tide that lifts all boats and give Wells Fargo that boost it needs. I mean, Buffett's in the name. He never sold on any of the news, so that's certainly encouraging for longer-term investors. And at the moment, given the look on this chart, it looks like a lot of people thought that once Wells Fargo got down to the 50 level and, the majority of those negative headlines had passed, that this was a name to start piling away some money in. So this is one to keep an eye out on the long side that could certainly gain some momentum if the XLF continues higher.
Okay, what about Citibank? Ticker C.
Citi, I still own Citi. I still really like Citi. It's the best valuation out there. Given them a B minus on their earnings report. They had a dip in trading revenue of -1%. The only bank that did see that decline, which is obviously disappointing. Now, their rev growth overall was up 2%. And they still are the laggard in the return on equity and the return on tangible common equity. However, I would note that their ROE was the only one that went up quarter over quarter, as it was 7.4% in Q1 compared to 9.2% in Q2. Certainly very, very positive there. I talked about the valuation on a book value per share. They remain the cheapest in the group. They trail only Goldman in terms of the forward PE. Their net interest margin at 2.75% came in up 11 basis points. They certainly have some difficulty in terms of their international exposure, makes FX headwinds and overall global trade patterns a potential impact. A lot of their business, they got about 51% of their business internationally. A lot of that's through multinationals, which will continue to see a headwind. The dollar hit it, I don't know if it hit or came close to a 52-week high today. I haven't taken a look at that in a couple minutes here. But that obviously remains a strong dollar is a bit of a headwind for Citi. But, it's put in a nice bottoming pattern in this 65 to 67 area. And I'm looking for this to regain its swagger a little bit and be able to get back for a key test of that 200-day moving average at 72, which it has failed to get above twice, or twice. Once in late April, the other time in early May. So that's going to be the key level for us to watch here. But it's again another one that hit its high on January 29th. January 29th, it was trading at a high at 80.70, and then was in a downward trend that it is in the midst of trying to get back above. So, I still like Citi from the long term. I did take some off up at this 78 area, and there's a chance that I could add some back on.
Okay, and last but not least, let's talk about the Goldman Sachs.
Yeah, we've talked a lot about Goldman. I gave Goldman a C plus because they missed on trading revenues, and it's Goldman. And again, they're kind of a victim of their Q1 results where they blew out by so much. But when you see its peer Morgan Stanley perform so well, that also kind of weighed in on my grade here for Goldman. Again, they were second only to Morgan Stanley on revenue growth and net income growth. They were the tops in the fixed income, currency, commodity year-over-year growth at plus 45%, which easily outpaced everybody else here. There had been rumors that they were performing well on the fixed income side, and they certainly hit on all cylinders there. Their equity trading revenue is only up 1%, but again, their FICC trading is about 2.5 times the size of their equity trading desk, as people could see in that chart that we have posted there. And again, their forward PE is cheapest among there, and I just think that this looks like the most intriguing valuation play and chart out there given the Goldman strength. Now, the bigger, and I do like what they're doing in their move into consumer. They did provide some numbers on Marcus, which is performing very well, and I think you're going to see Goldman Sachs kind of follow Morgan Stanley's footprint when this consumer banking unit becomes a bigger part of it and provides a little bit more stability to these Goldman earnings, and they really start outpacing on some of the other aspects. And again, another bank, now these guys hit their 52-week highs on March 12th, so it's interesting that they kind of had a divergence from the other banks. Now, a lot of that was due to the heavy volatility that we saw in Q1, in which Goldman was viewed as going to be a likely winner, and they certainly proved that and lived up to the expectation in their Q1 earnings report, which was back on April 16th. However, that still wasn't enough to get this guy moving, and we saw it slide down, break below the 200, and finally flatline in that 220 area. Now we're starting to see signs of that downward trend being broken. A popular theme that we've been touching upon here over with all these names and the XLF in general, and Goldman just looks like a pretty exciting trading vehicle here at the moment. Unless that's my margin call coming in, of course, Jim.
Yeah, well, all right. So let's pretend that you don't own any of these banking stocks, and just on the surface, if you had to own one, which would it be?
What time frame?
Give me one. Give me one for. I was thinking more longer term for the end of the year. Which one? If you're trying to get some portfolio exposure, which one would you choose?
So, to be honest, I don't think there's one you can really go awfully wrong with, but I would say Morgan Stanley.
Okay.
And I think, again, as I've been saying, the most tradable one is Goldman Sachs for like a shorter term swing trade. But, I mean, Morgan Stanley just continues to put up really good reports. Gorman is proven to be one of the top CEOs out there. I love Citigroup and Bank of America, and I've been in them from way back because of how cheap their valuation is. But, BAC needs to get through that flattening yield curve. Citigroup needs to deal with strong dollar and stuff. So probably a little bit more fluctuations there. Not saying that I don't like them, but, just doing a compare and contrast. JP Morgan is priced at a premium, a well-deserved premium, but therefore I think he could find a little bit more upside in Morgan Stanley on a longer-term investment. And then Goldman, again, I'd see that as a nice trading vehicle, but given the uncertainty with the transition over to Solomon and the potential, I don't think that they will do it, but the potential for missteps in their move more towards the consumer banking, which is obviously a lot bigger structural reform than that, you have to take that into consideration, and that would maybe kind of scare me off a little bit on a longer term investment. But again, I don't think that you're throwing bad money away by any means if you did like Goldman on the longer term. And then Wells Fargo, it certainly looks attractive given how beat up it is, but there's still some headwinds that they need to get through, and we don't know the long-term impact from this in terms of, are they continually seeing market share losses because of their name being dragged down a little bit in the mud? We certainly saw the Q2 results lagged its peers, and does that become the new trend, or is this kind of a 1 or 2 quarter off? I prefer to see Q3 results before I was really looking at that as a longer term investment. But then again, you got Warren Buffett in there, and from my understanding, he's an intelligent man, so he's in there for a good reason. But That's basically how I look at these names right now.
All right. Well, as always, Gavin, thank you. I'm sure the listeners appreciate all the coverage and breaking down just all these metrics and what they mean for the bottom line for these in terms of growth and all that. So thank you so much for doing that. And let's see, just as a recap, you gave Morgan Stanley an A minus. You gave J.P. Morgan a B. Also getting B was Bank of America, Wells Fargo, a C grade, and Citi, ticker C, got a B minus. And Goldman Sachs, you gave a C plus.
Correct.
All right. So your grade reflects your current opinion that if you